Hello and welcome. My name is AJ Arango, and I would like to talk about the basics of stock options. In this introduction, I am going to explain stock options in a clear and practical way for people who are new to investing in options, but already have a basic understanding of what stocks are. This is for educational purposes only. It is not financial advice, legal advice, or tax advice. Let's begin with the basic question. What is a stock option? A stock option is a contract tied to a stock or an ETF. It gives one person the right, but not the obligation to buy or sell shares of a stock at a specific price by a certain date. That definition is important, so let me say it a little more simply. An option is not the stock itself. It is an agreement connected to the stock. You can think of it like paying for a reservation. Imagine you pay a small fee today for the right to buy something later at a fixed price. If the market price goes up, that right may become valuable. If the market price does not move the way you hoped, you can let the reservation expire and only lose the fee you paid. That is one of the big reasons stock options matter. They allow investors to make decisions based on future price movement without necessarily buying or selling the stock right away. Options are widely used for three main reasons. First, some people use them to speculate, meaning they are trying to profit from a stock moving up or down. Second, some people use them to manage risk, which is also called hedging. Third, some investors use them to generate income, especially when they already own shares. So options can be flexible and useful, but that flexibility also means they can be confusing and sometimes risky if you do not understand how they work. Now let's look at the two basic types of stock options. The first type is a call option. A call option gives the buyer the right to buy a stock at a set price by a certain date. The second type is a put option. A put option gives the buyer the right to sell a stock at a set price by a certain date. Those are the two core building blocks of options. Calls are usually associated with the idea that a stock may go up. Puts are usually associated with the idea that a stock may go down. Let's walk through a simple example of a call option. Imagine a stock is trading at $50 per share. You buy a call option that gives you the right to buy that stock at $55 per share anytime before the option expires next month. If the stock rises to $65, your option becomes more valuable because you have the right to buy at 55 while the market price is now 65. That right has value. But if the stock stays below 55, your call option may expire worthless because it would make no sense to use your right to buy at 55 if the market is offering the stock for less than that. Now let's do a put option example. Imagine a stock is trading at $80. You buy a put option that gives you the right to sell the stock at $75 before expiration. If the stock falls to $60, your put becomes more valuable because you have the right to sell at 75 while the market price is only 60. But if the stock stays above 75, the put may expire worthless. So in the simplest terms, call options can benefit from rising prices and put options can benefit from falling prices. Now let's go over the key terms that every beginner should know. The first term is strike price. The strike price is the fixed price written into the option contract. It is the price at which the buyer may buy or sell the stock, depending on whether it is a call or a put. The next term is expiration date. Options do not last forever. Every option has an expiration date. That is the final day when the contract remains valid. This is one of the biggest differences between owning a stock and owning an option. A stock can be held for years or even decades. An option has a clock ticking on it from the moment you buy it. The next important term is premium. The premium is the price of the option itself. If you buy an option, the premium is what you pay. If you sell an option, the premium is what you collect upfront. Another pair of terms that matter a lot are intrinsic value and extrinsic value. Intrinsic value is the amount an option is worth if you exercised it right now. For example, if you have a call option that lets you buy a stock at $50 and the stock is currently trading at $58, then that option has $8 of intrinsic value. Extrinsic value is everything in the option's price beyond that immediate value. It is sometimes called time value. Extrinsic value reflects possibility. It represents the chance that the option could become even more valuable before it expires. Here's a helpful way to think about it. Intrinsic value is what the option is worth right now. Extrinsic value is what the market is willing to pay for what might happen next. You will also hear the phrases in the money, at the money, and out of the money. If a call option would be profitable to exercise right now, it is called in the money. If a put option would be profitable to exercise right now, it is also called in the money. If the stock price is very close to the strike price, the option is at the money. If exercising the option would not make sense right now, it is out of the money. These terms simply describe where the option stands relative to the current stock price. Now let's talk about how options trading works in practice. Most standard stock option contracts represent 100 shares of the underlying stock. That is a very important detail. If an option is quoted at $2, that usually means $2 per share. And since the contract controls 100 shares, the total cost is actually $200, not $2. This is a common point of confusion for beginners. When people trade options, they are generally doing one of four basic things. They are buying a call, buying a put, selling a call, or selling a put. Buying and selling options are very different. That difference is one of the most important things to understand. When you buy an option, you are paying for a right. When you sell an option, you are taking on an obligation. Let's start with buying options. If you buy a call, you usually want the stock to rise. If you buy a put, you usually want the stock to fall. One reason buying options appeals to many beginners is that the maximum loss is often limited to the premium paid. If the trade goes badly, the option buyer can often lose only what was paid for the contract. That sounds attractive, and it can be. But there's a catch. The stock not only has to move in the direction you expect, it usually has to move enough, and it has to do so before the option expires. You can be correct about the direction and still lose money if the move happens too slowly or too late. Now let's look at selling options. When you sell an option, you collect the premium up front. That sounds appealing because it feels like immediate income. But that premium is not free money. In exchange for receiving it, you are taking on an obligation. If you sell a call, you may be required to sell shares if the buyer exercises the option. If you sell a put, you may be required to buy shares if the buyer exercises the option. So while option buyers usually have defined risk, option sellers can face much larger risk depending on the type of position. This is especially true for uncovered or naked option selling, where the seller does not already own the shares or cash needed to fulfill the obligation easily. That brings us to one of the most talked about features of options, which is leverage. Leverage means controlling a larger amount of stock exposure with a smaller amount of money. This is possible because an option contract often controls 100 shares. For example, if a stock trades at $100 per share, buying 100 shares would cost about $10,000. But buying one call option tied to those 100 shares might cost only a few $100s. That smaller upfront cost is what makes options feel powerful. If the stock moves strongly in your favor, the percentage gain on the option can be much larger than the percentage gain on the stock itself. But leverage has a downside too. It magnifies losses as well as gains. If the stock does not move as expected, the option can lose value quickly and in some cases become worthless by expiration. So leverage is not magic. It is simply amplified exposure. It can help and it can hurt. Now let's talk about the role of market makers and liquidity. When beginners imagine trading, they often picture one investor buying from another investor directly. Sometimes that is effectively true, but much of the market depends on professional trading firms called market makers. Market makers help keep the options market active by continuously posting prices at which they're willing to buy and sell. This helps create liquidity. Liquidity means how easily you can enter or exit a position without a large price penalty. Highly liquid options are easier to trade. Less liquid options can be harder and more expensive to trade. One important concept here is the bid-ask spread. The bid is the highest displayed price a buyer is willing to pay. The ask is the lowest displayed price a seller is willing to accept. The difference between the two is called the spread. A tight spread is generally better for traders. A wide spread can make it more costly to get in and out of a position. You may also hear about volume and open interest. Volume tells you how many option contracts traded during a certain period, such as a day. Open interest tells you how many contracts remain open. Both can help you judge how active an option is, although neither one guarantees a good trade. In general, beginners are often better served by options that trade actively and have relatively tight spreads. Now, let's discuss the potential rewards of options. The rewards are real. Options can offer flexibility, they can allow defined risk for buyers, they can provide leverage, they can also be used to hedge a portfolio or create strategies that are difficult to replicate with stocks alone. For example, an investor who owns shares of a stock may buy puts as a form of downside protection. That can work a little like insurance. If the stock falls sharply, the puts may increase in value and help offset some of the loss in the shares. Another investor might use calls or puts to express a short-term view without committing as much capital as it would take to buy or short the stock directly, but the risks are just as important. Option buyers face time decay, meaning options lose value as expiration gets closer, all else being equal. They also face expiration risk, which means the option may simply expire worthless. Option sellers face assignment risk, meaning they can be required to fulfill the contract. They may also face margin requirements, where the broker demands more money if the position moves against them. And some strategies can expose the trader to very large losses, so options are not automatically dangerous, but they do demand respect. A good beginner should understand not only what can go right, but also what can go wrong. Now, let's go over some common misconceptions. The first misconception is that options are just gambling. That is not accurate. Options can be used recklessly, yes, but they can also be used responsibly. Many experienced investors use options to manage risk, protect positions, or structure trades with defined outcomes. The instrument itself is not automatically reckless. The way it is used matters. The second misconception is that selling options is easy income because you collect premium upfront. This can be misleading. Some option selling strategies may win often, but when they can lose big. A strategy that makes small amounts regularly can still be dangerous if it occasionally suffers a very large loss. So collecting premium should never be mistaken for guaranteed income. The third misconception is that cheap-looking options are bargains. An option with a low premium is not necessarily a good deal. It may be inexpensive for a reason. Maybe expiration is very close. Maybe the strike price is far away from the current stock price. Maybe the market believes the probability of success is low. Price alone does not tell you whether an option is attractive. Now let's briefly touch on taxes. Tax treatment for options can become complicated quickly. In general, taxes can depend on the kind of option, whether it was bought in a brokerage account or granted by an employer, whether it was exercised or sold, and how long related stock was held. Some stock options connected to compensation can be treated differently from ordinary listed options used in investing. The main beginner takeaway is simple. Do not ignore taxes. Keep good records. Understand that timing matters. And if you begin trading options seriously, consider speaking with a qualified tax professional. Now, a quick word on regulation. Options trading is regulated, and brokers generally do not allow everyone to trade every type of option strategy automatically. Most brokerage firms require specific approval for options trading. They may ask about your experience, financial situation, and investment objectives. They may also limit which strategies you are allowed to use. Before trading listed options, investors are also generally expected to review the official options disclosure document, sometimes called the ODD. This document explains important characteristics and risks of standardized options. That requirement exists for a reason. Options can be useful, but they are not simple enough to trade casually without education. So where should a beginner go next? The best next step is not to rush into advanced strategies. Start small, conceptually. Learn exactly what a call is. Learn exactly what a put is. Learn how strike price, expiration date, and premium work together. Practice reading an options chain. Compare what happens when you buy a stock versus when you buy a call or a put. Study how time affects option prices. Learn what liquidity and bid-ask spreads mean in real trading. And most importantly, understand the difference between having a right and having an obligation. If I were teaching this in one sentence, I would say this: a stock option is a time-limited contract tied to a stock that transfers rights and obligations at a fixed price. Once that idea becomes clear, everything else starts to make more sense. To wrap up, stock options are powerful tools. They can be used for speculation, hedging, and income strategies. They offer flexibility and leverage. They also introduce new risks, including time decay, assignment, margin pressure, and the possibility of losing the entire premium paid or more in some selling strategies. For beginners, the goal is not to master every advanced strategy right away. The goal is to build a strong foundation. Understand the language, understand the mechanics, understand the risks, and take your time. Thanks for listening. This has been a beginner-friendly introduction to stock options for educational purposes only and not investment advice.